Well, we called it. We called the dead cat bounce. We got it on Wednesday, but Friday looked a little shaky. Riz and I are going to talk about what to expect this week in the stock market. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our Elite webinar. Now, if you want to get the most up-to-date, unbiased information on the stock market, then you need to get down there and hit that like and subscribe button. Click the bell icon to get notified when we upload a new webinar each week here on the channel, so that you get all of the information that you're not going to hear on any of the talking heads that you see on the television. Now, I am joined tonight by the man himself, Riz Memon. How you doing, brother?
Doing good, Chris. Yourself?
I am doing all right. It's a beautiful fall day here in Indiana, and let's talk about the stock market. So we were talking about this last Friday, right after the Fed paused rates and said, "Okay, yeah, we're not going to be cutting rates anytime soon." The market started pricing out rate cuts, and we saw the dip. We talked about it, right? We talked that we were expecting a bit of a jump, or a bit of a bounce, rather. We call it the dead cat bounce. And we really kind of got it here on Wednesday, I would say, with this huge doji candle. Let me zoom in on this a little bit so you can see that long tail there, that big indecision. And then we started to come back up a little bit on Thursday. We opened up rather high on Friday, and then the market just gave it all back and then some. Riz, quite a wild week in the market. What are you seeing from your end?
Yeah, it's been a bearish month. In fact, the worst month since 2022 December. So the market, the index, the S&P 500, like we have here, is down approximately 4% for the month of September. So that's a sizable drop, right? Considering we were the market was up like I think like 15, nearly 20% at the peak. Yeah, roughly look at that. Right. A little bit more than 4%, but yeah, think about it that way. Like, wow, that's a pretty decent pullback. So when I said, we have a little bit of a pullback, it's not a crash, it's not a meltdown. It is a healthy pullback because, like you said, the market needed to price out rate hikes. We're now in Q4. We're in a situation where, okay, well, where do we go next from a central bank standpoint, from a rate standpoint? Where do we go next? And now the market's really kind of trying to do its thing. Does it mean that we're in the clear now and it's completed pricing out potential rate cuts? Not quite. Not quite. We could still see some more downside. I do have some long positions, but I'm still roughly over 70% cash. I don't have the exact number on me, but still over 70% cash. Still have some, again, long positions open, but they're all solid companies I'm okay holding. And this sets me up nicely, and of course, hopefully other elite members, to really kind of wait. We have been waiting. It's been a slower week for sure this week from an elite standpoint in terms of our trades and our activity, but that is by design. That's by choice. Because as you could see, just Thursday and Friday itself are two opposites, right? Like you got that, not a pure doji, but you got kind of like that, almost like a bullish hammer there almost, but on Wednesday, but then you got a nice bullish day on Thursday without a doubt, and then Friday complete reversal after a bullish open. That's very indecisive, and it didn't help that it was the last trading day of the month, plus the last trading day of Q3, and as is obvious, we are now in Q4, and boy, oh boy, do I think it's going to be a bit of a doozy. So, generally speaking, from a seasonality standpoint, Q4s are usually bullish. Usually, remember, history doesn't often repeat itself, but it does rhyme. But keep in mind that you can't solely, come to conclusions solely based on historical events. So while I keep that in mind, we can say, okay, maybe it's a bullish quarter. Maybe, we start seeing things pick back up. But by no means do I think we're in that situation where we see 4,600 or let alone 4,800 of the 2021 or 20, I think, yeah, 2021 highs of 4,800 or so. We're not going to see that. But we could see a little bit of a pickup. We have the 200-day moving average at 4,200. That I think is still in play, especially after Friday. We could actually see a little bit of a pullback, continuation lower. And then obviously it's going to also come down to some of the events, macro events that we have coming up this week.
Yeah, we do definitely have some events coming up this week. We'll talk about that a little bit later, but let's take a look and see what's going on here with the S&P 500 as we have this, this rather a bullish month as we're talking about. So, or excuse me, bearish month. I misspoke there. My mistake. So, more of the same, I would say, but we are seeing some sectors recovering a little bit more off of that bounce than others. So you can kind of see here that communications and tech had, a bit more of a rebound than what we saw, with the market itself. If you look here in comparison, obviously the SPY, the ETF that tracks the S&P 500, not a really big bounce, but definitely tech getting a bit of a nice push as communications as well, and consumer discretionary also kind of perking up a little bit here going into Friday, even though we saw a rather red day on Friday. But the rest of them, rather, energy taking a nice big dip on Friday here, as we can see, and everything else has gone down below the zero line now. We've got financials, healthcare, consumer staples, real estate, and utilities all in the dumpster. Riz, what would cause, like some of these sectors like tech and communication to be a little bit more resilient to this drop, in particular than the other sectors?
So we know the prior week we saw when the bearishness started, we saw pretty much wide sell-off in pretty much all sectors, right? So it wasn't like a rotation. This time around for this week, especially the last couple of days of this trading week, we saw a little bit of momentum, bullishness. I'm not gleaning too much into it. I'm not looking too much into it. It's nothing I would say solidified. There's nothing solidified about this kind of little bit of a pickup in consumer discretionary, a little bit of a pickup in tech. So nothing too much to be gleaned from that. I think the most important thing is the market is still leaning a bit bearish. You can see that the S&P 500 is now about 11% up year to date. We still have 3 months left of the trading year, unbelievably, in 2023. And we have not seen that all-time high as was obvious. We saw a high of 4,600 on the index, and I think that level, I don't see any reason for us to get back there. So what I'm saying in a nutshell is I think there's a little bit more downside to come. We could still end up having a bullish Q4, but keep in mind that doesn't mean we're going to see 4,600 or all-time highs on the index. I could be wrong, but that's my thesis, and I'm standing by that. It's always a moving benchmark. It's always a moving target. But as of right now, I do foresee a little bit more downside. The longer term I look, by long term, I mean into 2024, first half of 2024. When I look into that time frame, I see even more bearishness. Okay, that's me. I will, of course, keep everyone, whether it's an elite or social media and YouTube, updated as things go. Like I said, it's a moving target. But as of right now, I am willing to go on record and say I am more leaning bearish in that long term, 6 to 8 months out from now.
Yeah, I mean, there's a lot of negative pressure on the market right now with everything going on in the world. I mean, obviously, there's quite a few external factors pushing the market that direction. And yeah, I don't want people to think that we're like forever bears here. That's not the case. Obviously, there are times that the market's going up and times that the market's going down. And being able to trade and make money during both of those times is critical to being a successful trader in the market. So just because we've talked about, being more bearish here over the last, I'd say 3-4 months, to be honest, it doesn't mean that we hold that sentiment forever. Just because we see, some longer term downward pressure doesn't mean that it's always going to be that way.
Yeah, good. I'm glad you mentioned that, Chris, because that's important. There's a lot of, bias with people, especially when clicks and views are involved. There's a lot of bias, a lot of extremism, so to speak. And you're right. I 100% stand by that. We are not perma bears. We're not perma bulls either.
Yep.
I look at things in as neutral and unbiased standpoint as possible with the information that I'm seeing and the data I'm seeing. And then of course, as things shift and move, I too will adjust, and then of course keep everyone else in the loop as well. Um, but one thing I will add is yes, we are bearish, but that doesn't mean it's a straight line down. So I always
Oh yeah.
tell people I can be bearish, but within that broader bearish view, there can be little mini rallies that I may very well might try and take advantage of, or I might not, whatever I see in front of me. But it's important to discern that. People are like, Riz, you're bearish, and look, the market's up 2% this week. Ha ha ha. No, I'm bearish in the broader sense, but doesn't mean every day is going to be a red day, or I feel like every day the market is going to keep dropping. No, that's not reasonable. Even back in 2008, I recall very vividly, there were times as things were collapsing, as we saw massive cracks forming, and we saw these craters happen in the markets. Even that time when banks were going under, there were points in that period where there were bullish, very bullish days, very bullish weeks,
Hmm?
and maybe even some bullish months, bullish to neutral months. So even when you have that kind of overall financial collapse type of situation, which is a very different time and different economic and market environment, but even within that, you have little rallies, you have little bullishness, you have the pendulum swing in a different way, right? So keep that in mind. When I say I'm bearish, whether it's in the short term, whether it's a couple months, quarter, or whether I'm bearish for 6 months, half a year, the next year, keep in mind that this doesn't mean it's a straight line down. And we could very well have, the market go up 5%, 3%, 10%, and then give back some.
Oh yeah, definitely. The market goes up, the market goes down, and being able to be versatile, to be agile, and be able to read that situation is critical for success long term. Now, let's go ahead and take a look here at the asset classes. And it was a bit of a wild week in oil here. Had quite the spike on Wednesday when the market was so indecisive, making a big run up here to, let's see, looks like 93.68 with a very sharp pullback on Thursday and Friday, coming right back down here towards the 90 area, which seems to be somewhat of a magnet right now for oil because we just can't seem to close too much higher than about 90.80. We've hit that twice now. We'll have to see this week how that goes. But man, look at gold. That is what I call a dip right there. Whoever says the dollar's dying and gold is going to the moon, I'd like to show you this chart because sure doesn't look like gold is going to the moon right now. That is quite a substantial drop in gold. Riz, what's your take on both of these?
Yes. So first we'll reverse the order. We'll start off with gold. Yes, big drop. Not interesting to me at these levels yet. Maybe at 1,800 an ounce, it starts, kind of piquing my interest a bit. But right now, not so much. Quite surprising, actually, that gold kind of reverted this much at this kind of a drop. But even that, nothing I'm too excited about. From oil standpoint, yes, you're absolutely right. That 90 is kind of like that magnet. We kind of keep hovering, and we have been almost all of September, kind of been in that area, that 90 area. But nonetheless, a nice big pickup, push past the 85 to start off September. And in my view, I think, there is a possibility we see $100 a barrel again. I'm not quite okay with making that projection of 120 or 140 or 200, which is stupid. That's not happening. But I think that 90 to 100 is possible. But I will say once again that I alluded to last week that at these levels and based on what we see at the pump, depending on what country you're in, what state, province, whatever, we will start seeing a little bit of demand destruction. We will start seeing, less, I would say, automobile travel compared to the thick of summer. That's not rocket science. That's just what it is. That's essentially seasonal. So keep that in mind too. I think now I will also remind you that when it comes to gas prices and inflation, if we see gas prices move materially lower, like they come down, maybe another 5-10%, and then let's assume oil also comes down another 5%, 5-10%. Guess what? That's going to have a downward pressure on inflation. It's going to bring inflation down. So keep that in mind. I think if we were at I can't remember exactly what the last inflation print was. But I think it was
Oh,
like
I don't. Don't recall.
3.3. Yeah, 3.3, something like that. I know Canada's hit 4% because of gas prices, right? So if we feel like gas prices peak at 90 to 100, technically that could also signal the peak of inflation for the near term, right? So inflation might have more downside, which is actually a good thing. But uh, it has like how it's interpreted from the market standpoint is also different because the market could actually not only take lower inflation as bullish, but it could also mean that the economy is cooling, right? And then if you go one step further, that might signal rate cuts, which is what obviously the market was pricing in or already had priced in uh for Q3 and Q4, but that's not happening. I very, very, very doubtfully, I don't think we're going to see any rate cuts. And then even now, there's still some musings of maybe one rate hike, 25 basis point, maybe. I feel like that's a little bit of a coin toss as well. But more often, I think more likely is that we just kind of hold at these levels at the current benchmark rates.
Yeah, that makes a lot of sense, honestly, since some of that inflation data is heavily weighted into the price of oil and things like that. I know the CPI has a lot to do with the price of oil, and so that they can get that down. That's obviously good, which is why they were releasing supply from the Strategic Oil Reserve,
Yeah.
to try and keep that price down. But now that we can't do that anymore, well, it's time to pay the piper, as you like to say.
Yeah, they haven't done that. There hasn't been any news of more supply out of SPR. So from what I
Mhm.
recall, it's kind of like at the halfway mark still. There were some rumors that perhaps, but again, we hear these things whether genuine or not, whether they have any credibility or not, we just hear these things. But from what I'm aware, there hasn't been any further increase in supply or a drawdown of the SPR. So depending on how you look at it, that's good and bad news. And I feel like it's going to be an interesting Q4 to see where we settle. I mean, I find like usually December is a bullish month. Santa Claus rally maybe is what we call it, but
Yep.
I feel like we're in that kind of year. We're in that kind of market where I think anything goes really. Like we can't look back and really compare the situation. With the biggest thing being we literally just come out of one of the highest inflation periods in the last 20, 30 years, even I think longer, 40 years or so. We've also just come out of a massive rapid hiking cycle for rates. So it's very different to, you know, let's say 2008 or even early 2000s.
Yeah, it's definitely a different animal these days. Let's take a look here at the bond yields and the dollar. And, one thing that I'm seeing here with the bond yields is the 2 years starting to slow down a little bit. This week, we seem to be kind of cooling off a little with these 2 years. And I would say the 30 year and the 10 year are starting to make some gains here, getting a little bit closer, in parity with the 2 years, and the dollar just continues to run. As far as the strength of the dollar is looking very strong right now. Now, remember, of course, this is compared to the other major currencies of the world, not a currency pair. So just keep that in mind. But yeah, Riz, you always say that the bond yields are more forward looking, or the bond market is forward looking, while the stock market is somewhat the other way around. They're all about the here and now. With this rise in the 30 and 10-year bonds, is this, potentially a good thing that we're seeing? Or how should we interpret this data?
Yeah, they're both forward-looking, stock market and bond market, but the bond market is a little bit different in that they views things from a different lens, so to speak. That's the best example I can give you.
Okay.
Both looking at it from a different lens, and the bond market, as I've said before, from an asset standpoint, is bigger. There's more debt out there, right? That's what bonds are, whether it's government debt, corporate debt, so on and so forth. This is interesting because yes, you're right. The spread is narrowing between the 2 year and the 30 and 10 year. So the spread is narrowing between 1030 to the 2 year. Okay. So it's interesting. I wouldn't make too much of it. We've seen that before. Like look at March all the way to like May, right? We saw that tighter spread between all three of the yields. So it spread further, especially the 2 year just ran away from the other two. But right now it's kind of closing in a little bit. I think it can stay here. The moment we start seeing, could be next year, based on my purview, that maybe, the Fed starts signaling a potential drop, then we're going to see bond yields, drop, a little bit pullback, right? But until then, they could very well hover here. Yeah, maybe the spread increases, decreases. I don't think that's too big a deal right now. But we do know for pretty much the entire year, the bond market has signaled some economic slowdown to come, right? Whereas up until the last couple of weeks, the stock market was shrugging that off. So both forward looking, but both from a different lens, both had their own kind of different thesis, so to speak.
That makes a lot of sense. All right. If you're here on our live webinar and you have a question for Riz or myself, but we all know you're here for Riz, go ahead and start putting that in the chat now. Let's take a look here at the, what we have coming up this week as far as the important dates. So let's see here. It looks like on the 2nd, we've got manufacturing PMI. That should be interesting. Job openings on the 3rd, going to be a rather, I think, more interesting one coming up. And then more so on Friday, we've got the unemployment rate, which I think that will be the big catalyst this week. If I had to pick one, that's going to be my pick for the week as the biggest catalyst. Riz, is there something else we need to be keeping an eye on?
Yep, payrolls and unemployment, absolutely the big two, with the third being a little bit important as well. Job openings as well. Manufacturing PMI is important from like it kind of gives the manufacturing sector is kind of like a lot more of a forward or a lot more leading macro indicator. So it gives us an idea of what's happening in that sense, right? Where is manufacturing going? Are suppliers ordering more? Are they ordering less? Are these companies relying on suppliers to increase production or decrease production? Are they canceling orders? So all that stuff does matter. But if I have to say in simple terms, the big ones are job openings are important, but especially with payrolls and unemployment on Friday morning.
Gotcha. No, that sounds good. So yeah, okay, here we go. Abhishek is on it. This is rather fortuitous. Abhishek says, AMD is coiling up tighter. Feel like if we get back down to mid-level, it would be a good for a starter position. What do you guys think? Let me tell you a little story here, guys. So on Wednesday, or no, it was Tuesday in Riz and I's private chat with Glenn. I was like, hey guys, take a look at AMD. Do you think we might want to take a look at this? Oh no, I don't trust it, Chris. I don't trust this market, and I'll agree, but man, Chris nailed it on that one. So yeah, AMD really bouncing hard off of the 200 SMA here, which is the light red line here, making a huge gain here, though starting to kind of roll back over a bit. So wondering if it gets back towards the mid 90s. So that would be basically a retrace back to the 200 simple moving average. I feel personally that's a little risky since we've spiked up and then we come back down and you're expecting a similar move while the overall down trend here on AMD is down as far as, from a technical analysis standpoint is concerned. So I kind of feel like we might have missed the move on AMD. Not that I'm trying to toot my own horn here or anything, but it looks a little dicey. Riz, what are your thoughts here?
Yes, absolutely. You were right in hindsight on that AMD long play midweek. Obviously we didn't execute on that. It was a good trade idea, absolutely. So I will acknowledge that. But in terms of the question, if we do see 95, I would not be frothing at the mouth or jumping with joy to get in long just yet, because that means it's a rejection of that 100 area. 102 in this case is the rejection of that downward sloping trend line that Chris just drew. And I think if we're back around 95, 96, that means you're right at the 200-day moving average. Now I want to pay attention to what's happening with that level, what's happening in the broader market. So I cannot preempt that. I think it's dangerous to say, okay, if it gets back to 95, 96, it might take a long. No, because we want to look at that situation again with everything involved. So not just in a vacuum. We want to see what's the broader market doing, right? Is there any catalyst? So I wish I could be like 95, 96, 200-day moving average, boom, buy. based on what happened in this month, yeah, the 200-day moving average was a nice area where it consolidated a little bit and then rallied. But does that mean it's going to happen again? Not necessarily. If you do get a break below the 200-day moving average, so 96, 95 level, that actually would be quite bearish. So on the flip side, might actually be a bearish setup.
Yeah, I just think it's dangerous to try and play it twice, in such quick succession. If we get, rather bearish move down there here over the next couple of days, if we do see that, increased, downward pressure in the market, it definitely could propel this even further down. So yeah, be real careful on that. But a good idea, just about 4 days late. So your head's in the right place. I'll give you that much. But yeah, I think just kind of keeping an eye on the overall market when it gets there and seeing how it behaves, give it a day or so at a minimum, and then make your decision. But I wouldn't just jump in the minute it hits the 200. Oh, nice. Well played. Obviously, Abhishek and I have the same thought process there. If you're in long already, I'd look to take profit, honestly. If that's the case. No, I wouldn't double dip. Okay, you're already long, then yeah, I would. What do you think, Riz? I'd be taking profits here pretty soon.
Yep. 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 That move on Thursday was extraordinary. Not really called for, but yeah, you take the money. He
Okay,
closed.
good.
He said he closed, so he doesn't want to double dip, meaning he doesn't want to get back in. Yeah, leave it. The
Sure.
trade's done.
Yep.
Watch from the sidelines. Maybe you take something else. Maybe you don't. But just watch from the sidelines. If it's a good opportunity, like screaming at us based on technicals and everything for long, sure. But right now, I don't see that.
Well played. That's all I'm going to say, buddy. Well played. You nailed that. Riz, what are you looking at this week? Is there anything that you have your eyes on? I know you always have your eyes on everything, but is there anything that's kind of tickling your interest, maybe getting somewhere where you want it to be?
Yeah, so there's quite a few things that are setting up nicely. I would say they're maybe at like 6 or 7 from an opportunity standpoint, whereas up until last 2 weeks, the opportunities I think were like 2 or 3. Like so like lower, closer to 1, meaning like not many opportunities at all. So we're at kind of like a 6 now where there are definitely some opportunities. I like I mean we're already in, so I'm just gonna give a little bit of a nugget to people on to YouTube. Usually don't, but I will say, J&J is something we're in. Chris, as you know, elite members know we're already in that. It's kind of dropped, continued a little bit further. Solid company, one that you can buy and hold and carry. So again, definitely not like a short-term trade type of thing, but definitely something to keep an eye on if it suits your style. Definitely oversold as well. In chat, Orlando says, Enbridge is also another one we've been keeping an eye on. We talked about it right at that 45 support, right? Important. Enbridge, pretty much all pipelines have been getting sold off, even though they're essentially energy companies by proxy. We know energies had done well this year, but these companies, pipelines, kind of fall into utilities almost. And we know what's happened with utilities, right? This year, like big drawdown, the worst performing sector in the S&P 500. And Enbridge is a Canadian company, but it does fall into a utilities company. So from that standpoint, yeah, definitely look a nice double bottom here, 45. So it'll be interesting to see if we get that. We do have another similar company that we're already long in. Elite members know that. I'm not gonna bring that up because I think I'll leave that for Elite. So we do have that exposure. It's another pipeline company, right? So those are the kind of interesting 2 plays for those that are not in it. For those of you not in Elite, ENB and J&J, both more solid buy hold type of positions, not kind of like the fast money, quick trade type of positions that maybe some people might want. So I will add that asterisk there and say, look, these are good companies regardless. But just keep in mind they might not play out like classical short-term swing trades.
Not like an AMD or something like that.
Yeah, right.
Exactly. No, that's great. Definitely gives you something to keep an eye on. And yeah, Johnson & Johnson, a great company, not going anywhere. And of course, if you buy and hold and you hold it for a while, you got that dividend. Of course, that'll be a little bit before you get to that next dividend payout, but still something to look forward to. Little extra free money for just holding the stock. And I'm never
Yeah,
one to turn down free money.
Johnson & Johnson has like what, like 2% 3% dividend, whereas yield, whereas Enbridge, for example, has like 7 or 8% annualized. So that's something to keep in mind, right?
Yeah,
Nice
for sure.
dividend on some of these utilities, but again, it might not be suitable for every trader's account, depending on their style, capital, and time horizon.
Definitely. I think somebody's pinging me on Discord here real quick. Let me check this. I can edit this part out of the video. Yep, somebody is. Let me see here.
Yeah, I have it right here. Senate approves. Uh, they approve the ability to extend the closure or not close the government, which is a miracle.
Yeah, yeah, I heard there was something on that about them to like a stopgap measure. So that obviously will be a pretty positive thing. I don't know if that's really going to move the market. Riz, do you think that's going to have any impact on Monday?
No, no, usually shutdowns are neutral, non-event, but from just like an actual country efficiency and decency standpoint, yeah, it's good that they are continuing to work and do whatever little that they do anyways. But yeah, they're not getting paid completely to just sit on their ass, so that's good.
Man, that would be the job, wouldn't it? I mean,
It is for many of them, but
yeah, for sure.
you know,
Yeah, we won't get into that here. No, great questions tonight, and definitely some good things to keep an eye on this week. So definitely keep an eye, like we said, on Friday. That's going to be a big one. Obviously, the payrolls and the unemployment rate. That's your big event this week. So keep an eye on your markets there. And yeah, thank you everybody for coming. Really appreciate all of you being here on the live chat, and especially Riz. Thanks for joining us again. It's always a pleasure to have you.
pleasure is mine.
And as always, have a great rest of your weekend, and we'll see you in the market on Monday.